Most of what you build with a normal chat dies with the conversation. You get your answer, the window closes, and then next month you start over. A Claude Live Artifact does the opposite. It stays connected to your files, your inbox, and your calendar, and keeps yourself current. So it is a workspace you open again and again with live data rather than a one-time answer. For a finance professional, that changes how the work feels. You stop rebuilding the same view every close and every deal, and you stop being the one who manually checks whether a number is still current. I'm gonna build two live artifacts. One runs a month-end close, and the other runs a M&A deal room. And on this deal, it caught a 34 million EBITDA difference between a seller's marketing materials and the audited statements that nobody had flagged. Now, if you want the prompts and the data sets from this video, they're all in the free community, which is linked in the description below. But for now, let's get into it. What live artifacts are. A Claude Live Artifact is an application Claude builds for you that stays connected to your data and it keeps itself current. A normal chat answer is basically a snapshot. It is right the moment it is written and it goes out of date the second the file changes. A live artifact is the opposite. It stays wired to the drive files, the emails, and the calendar it was built from. So every time you open it, the information inside is the latest version rather than whatever was true when you first ran it. It also does not disappear when the conversation ends. It sits in your library as a workspace you reopen and keep using. The reason that matters, and specifically for finance, is that finance work repeats and finance data moves. Close runs every month, diligence runs for weeks, and the underlying files change the whole way through. Now, a workspace that reads the current version each time is worth far more than an answer you have to build every single cycle. You reach for one whenever a process has more than a few moving sources and you come back to it more than once. You can find live artifacts in the artifacts section of Claude's left sidebar, which is the library that holds everything you have built. Claude gives you two ways to start. Create chat artifact or create co-work artifact. Chat artifact opens a build page with templates. Co-work artifact opens a fresh co-work session that already knows your connectors and asks you some planning questions. I'm using neither. I start from a blank co-work session and I write the prompt myself because that gives me control over Claude's role, the business context, which sources it reads, and how it handles information that conflicts. And it makes the build reproducible. Now, I'm going to show you how to use these in real finance work. I'm building two artifacts here, and I'll set up each one the same way. The data first, and then the prompt. Building the close workspace. The first build is a month-end close workspace, and close is the clearest case for a live artifact. The picture changes daily as reconciliations get signed off and emails land, so a workspace that reads the current state each morning beats a report that is stale by lunchtime. Everything here runs on an example company, Granite Manufacturing Group. So I picked a manufacturer because a close there has inventory, it has payroll, it has treasury, and they're all moving at the same time. Now, the connected Google Drive folder holds 5 files. The trial balance gives Claude the account balances at the end of the period and the overall shape of the business. The general ledger export sits underneath it with the transaction detail, so Claude can look at specific postings when a balance needs explaining. And then the reconciliation tracker is the operational backbone. 40 activities with owners, due dates, completion percentages, and open issues. The controller's close notes carry the management view around those numbers, which items are critical, why they matter, and what has to happen before the CFO review. Now, the last file is the Warehouse 3 inventory reconciliation approval, which is the supporting evidence behind one of the biggest items in the close. Gmail and Calendar are connected alongside Drive. The inbox has internal close emails prefixed with GMG close from payroll, operations finance, and the CFO. The calendar has the controller view, the CFO sign off, and the reporting deadline. That mix is the whole reason this works. The tracker is a snapshot from whenever somebody last saved it. The emails are current. A reconciliation gets finished on a Thursday and confirmed in a message, and the tracker still says open on Friday morning. What I want Claude to do is read both and to know which one to trust. I open a fresh conversation in Claude Cowork. On the model selector, I have Fable 5, Opus, and Sonnet. Fable 5 holds up better when it has to reason across several connector sources at once, and it produces a cleaner interface. So I go with Fable 5 for this build. The prompt is short, and every line in it earns its place. It gives Claude the role of corporate controller and finance transformation lead, which sets the perspective that it applies to everything after. It asks for a persistent live artifact instead of a dashboard, so Claude builds for the cycles after this one. It points Claude at the Drive folder, the GMG close emails, and the Granite meetings in Calendar, and tells it to ignore everything else. And that stops it wandering through the rest of my accounts. Then it defines the business objective. Work out where the close actually stands, find what is finished and what is not, surface the risks, and connect the information across every source. After that, I hand the interface over. I do not name a single page. I list the kinds of things that would help the finance team during close, summaries, task tracking, filters, and document references, and then I let Claude decide how to organize them. The last part of the prompt is what makes the output usable. Base conclusions only on connected information. Explain any uncertainty and use professional judgment when newer information supersedes older documentation. Leave that rule out, and then Claude treats the reconciliation tracker as truth, which just rebuilds a spreadsheet that is already 3 days out of date. Claude does not start drawing an interface. It reads the reconciliation tracker first, and then it notices it has only pulled part of the workbook. Then it tries a few different approaches until it has the rest of the sheets. From there, it works through the documents, the emails, and the calendar, comparing them against each other whenever they disagree. When it finishes, it reports what it found before handing the workspace over. The close is around 85% complete. Several tracker items are already stale because newer emails and an approved reconciliation say otherwise. 2 high-risk activities still need attention before the CFO review. Then the artifact appears on the right side of the conversation, and I expand it to full screen. The workspace opens on the Close Command Center, the homepage for the entire close. The completion status for the June close sits at the top at 85%, and Claude worked that out across the tracker, the supporting workbooks, and the emails rather than reading it off one file. Next to it is the reconciliation count. The tracker reports 19 complete. Claude shows the verified number and records why it differs, because Warehouse 3 was approved and nobody has updated the tracker yet. The remaining cards carry the number of high-risk reconciliations still open, and the next milestone from the calendar, which is the CFO review. Now below that is a section called What Changed Since the Tracker Was Last Saved. So Warehouse 3 inventory is now complete because an approved workbook and a supporting email supersede the tracker entry. Payroll is complete on an email confirmation that nobody has written into the tracker. The supplier XYZ invoice is still open because no confirmation has arrived, even though an accrual is planned against it. The page finishes with today's priorities, an action queue with an owner and a target time on every item. The reconciliation tracker page holds all 40 activities with category, owner, due date, progress, status, risk level, and open issues. The filters are what make it more than just a table. So I select bank accounts and everything unrelated drops away. I switch to accounts payable and it refreshes to vendor statement reconciliations, accrued expense reviews, and legal settlement accruals. I move the risk filter to high and almost the whole list disappears, leaving the few items that could actually delay sign off. Open items only strips out everything finished, and during a real close, that is the view most managers live in. The risks and open issues page is the register. Claude ranks every open item by whether it could move the financial statements and explain the call it made on each one. The fixed asset impairment assessment is the least complete high-risk item, and Claude ties it back to the Mexico subsidiary bank reconciliation, notes that the corporate approval may be needed, and flags a possible material non-cash adjustment. The legal settlements review is blocked by external counsel rather than by the accounting team, which changes who has to chase it. The allowance for doubtful accounts is where the sources fight each other. The controller's memo says the review is done, and then the tracker still shows it open. So Claude keeps it open until there is documented sign-off. The supplier XYZ invoice is a large exposure with an accrual and a backup journal entry already prepared. So what is left there is timing and paperwork rather than valuation. The financial snapshot page answers a different question, which is what the numbers look like based on what has actually closed. Revenue, gross margin, operating income, and cash sit at the top with context on each. Cash is the interesting one. The trial balance reports about $274 million and the controller's memo reports about $253.5 million. So Claude does not force them to agree. It explains that the memo uses a narrow operational definition of cash that leaves out money. Claude does not force them to agree. It explains that the memo uses a narrower operational definition of cash that leaves out money market and short-term investment balances, while the trial balance carries the full general ledger position. The last page is data sources and notes, and that is where you do your checking. Claude lists every source it used, what each one contributed, and then it documents every judgment call it made. The reporting dates that differ across the memo, the tracker and the emails, the allowance conflict and why it stayed open, the two cash definitions, the tracker roll-ups that came through incomplete. And before this goes anywhere near a CFO review, open that page and read each conflict back against the file in the drive. Confirm the Warehouse 3 approval is signed. Confirm the payroll email is a completion and not a plan. Claude has told you exactly which conclusions are resting on which piece of evidence, so those are the ones you verify. Building the M&A deal room. The second build is a deal room. It is another case where a live artifact is really useful because diligence runs for weeks. Documents arrive in waves, and the seller's story has to be checked against each new file as it comes in. So a workspace that holds all of it together and rechecks it is doing work you would otherwise redo by hand every time something new lands. The target is another example company, Greenstone Industrial Holdings, a manufacturer selling into aerospace, automotive, and industrial markets. Now the drive folder holds 4 documents, and they are the 4 you get on almost every deal. The audited financial statements are the foundation, the income statement, balance sheet, cash flow, and debt position, all of it audited rather than claimed. The confidential information memorandum is the seller's version of the story, the strategy, the market position, and the investment highlights. The management presentation is how management intends to position the business during the sale, and the customer revenue analysis is the detail underneath all of it, customer by customer, which is where concentration risk shows up. Gmail carries the deal correspondence prefixed with Greenstone deal between corporate development, legal, and the CFO. Calendar carries the management presentation, the due diligence review, and the investment committee meeting. The prompt follows the same shape as the first one. Claude acts as a corporate development director and M&A lead. It builds a persistent artifact. It reads the drive files, the Greenstone deal emails, and the Greenstone meetings, and ignores everything else. It designs the interface itself. The one addition is a rule telling it to separate confirmed facts from its own analytical conclusions, which matters on a deal because A number that came from a marketing document and a number that came from an audit should never sit on the same line without a label. Claude reads everything before it builds anything. Then it leads with the finding rather than the workspace. The memorandum markets adjusted EBITDA of 114.7 million at an 18.5% margin. The audited full year 2025 statement reports 80.7 million at 13%. Both documents are describing the same $620 million revenue. The deal dashboard opens on that headline finding instead of a company overview. Claude carries the $34 million gap through to what it costs. At the referenced 500 million enterprise value, the multiple moves from roughly 4.4 times EBITDA to roughly 6.2 times. The KPI cards underneath carry their sources with them. Revenue is 620 million, confirmed from the audited statements. Adjusted EBITDA shows 80.7 million and is flagged against the marketed figure. Free cash flow shows 35.5 million, sitting next to the 85.3 million in the memorandum. Net debt to EBITDA is calculated at 2.8 times. The top 10 customers generate 48.2% of revenue against the 38% in the marketing materials. Next to those is the deal posture section, and Claude does not collapse it into a yes or no. The business looks attractive, revenue growth is real, leverage is improving, and the customer base is full of large blue chip names. The sell side narrative overstates profitability and understates concentration. Claude splits the assessment into strategic fit, financial quality, narrative reliability, valuation risk, and executive risk, so a committee can work through it one category at a time. The narrative versus numbers page puts every management claim next to the evidence. Free cash flow is 85.3 million in the memorandum against roughly 35.5 million from the audited statements. And Claude picks up that management is guiding capital expenditure higher next year, which raises the question of whether the earlier years benefited from underinvestment. Customer concentration is 48.2% in the top 10 against the 38% claimed, with the top 35 customers accounting for 75.4% of sales. Contract coverage is 67% of revenue in one place and 94% in another, with no contract level evidence for either. And the Lockheed Martin renewal reads 2027 on one worksheet and 2026 on another, on a customer generating 49.6 million or 8% of revenue. The risk register takes those findings and it ranks them. Earnings quality sits at the top because it moves the valuation directly. And Claude recommends an independent quality of earnings review, the seller's EBITDA bridge, valuing the business on audited earnings, and an earnout if the adjustments stay disputed. Customer concentration and contract renewals come next, pulling the 48.2% and the conflicting renewal dates into one risk with contract reviews and reference calls attached. Free cash flow and capital expenditure is third. Below those sit deteriorating service margins, the debt profile and working capital at 36.7% of revenue. Every entry carries the financial consequences and the next action rather than just the flag. The due diligence tracker turns all of it into an execution view. 20 items, 13 complete, 6 in progress, and 1 not started, which puts the overall completion at 65%. The one that has not started is the customer contract review, and it is marked high priority, which is exactly where the concentration and renewal question gets settled. The work stream runs across financial statements, quality of earnings, customer contracts, legal, tax, and working capital, each with an owner, a due date, and a note on why it is still open. The investment committee page pulls it together into recommendation, proceed to committee with conditions. The thesis holds and the diligence items need resolving first. Claude documents which conclusions are already validated and which are still contingent on evidence that has not yet arrived. Now, before any of this goes into a committee pack, work through the documents and sources page. Claude assigns a reliability rating to every file. Highest on the audited statements, low on the January 2024 memorandum, mixed on the management presentation, and moderate on the customer workbook. Then read the known information gaps section, which lists what is missing. The full year 21 to full year 2023 statements, the monthly financials, working capital detail, the quality of earnings report, the credit agreements, and the contract documents. Every number Claude flagged came from a document sitting in Drive. So open the two files it compared and confirm the gap is real before you put a valuation on it. And that is the full build. 2 live artifacts from 2 prompts, one running a month-end close across Drive, Gmail, and Calendar, the other running a deal room that holds a seller's story against audited numbers. Both stay in the artifacts library, so next month's close and next week's diligence session open the same workspace instead of a new conversation. Now remember, if you want the prompts and the data sets from this video, they're all in my free community, which is linked in the description below. I'll see you next time.